Trump's tariff threats not strong enough to ruin markets' Thanksgiving party, India's latest GDP data falls short of expectations, and why there is simply no stopping Netflix. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. We are in the end game for 2024. One more episode to go that would take place next week, and then it's a wrap for 2024. So we're nearly there, and looks like even the markets, in the US especially, are in holiday mood already because you had a hot holiday shortened week in the US markets as Americans across the world celebrated Thanksgiving, also known as Turkey Day. So first things first, a very belated happy Thanksgiving to all my American listeners. I hope you guys had a lovely holiday and enjoyed some delicious turkey with your families. Right. Although it was a holiday shortened week, investors did have plenty of important news flows to contemplate upon as well as discuss at the dinner table. So it was not like, it was not like, oh, we're in holiday mood, so there's nothing to deal with. Of course, we had a lot of data to deal with, which I will take you through. But before I go into that, let me give you a quick snapshot, as always, about the US indices. All three indices ended in the green. They had a very strong finish in the build up to Thanksgiving. The Dow jumped 1.4%, and both the S&P 500 and the tech-heavy Nasdaq both jumped 1.1%. So largely fantastic day, a fantastic week for the U.S. markets as we enter December, the last month of 2024, and looks like U.S. markets are heading for a very strong finish. So let me welcome you to the first segment, as always, the Doctor's Weekly Snapshot, to discuss the key takeaways from the U.S. markets, which from the events that transpired last week. And no, I'm not talking about Thanksgiving parades and so on. I'm talking about the economic data which investors had to digest before they could digest the turkeys. There were two themes that dominated actually in the U.S. markets last week, and they are tariffs and inflation. So I'm going to start with inflation before I move into tariffs. And by the way, just a little spoiler, both these are very much connected. Okay, you'll see that tariffs is very much linked to inflation. And so it was not a surprise that these were the two themes that kind of dominated one after the other. As November came to a close, we got the data from Fed's preferred inflation gauge, the October PCE numbers. Remember, the Personal Consumption Expenditure Index is the inflation data from that is basically what the Fed looks at while making key policy decisions when it comes to rate cuts. And the good news is that this preferred metric definitely came in line with expectations. There is a bad news, however, which is, if I have to call it bad news, which is that October's PCE data did show a slight uptick in inflation month over month. So if you compare month over month, there definitely was a slight uptick, and any uptick in inflation is definitely not good news. It's not necessarily horrible news, but it's not great news either. So it had both good and the bad elements. October PCE inflation came in at 2.3% year over year, and core PCE inflation, which excludes the volatile food and energy costs, came in at 2.8%. Like I said, both were in line with economists' expectations, but on a month-over-month basis, however, overall PCE inflation jumped 0.2%, and the core PCE grew 0.3%. So that is, if I have to call it bad news, well, then that's the negative, that it did show an uptick month over month. While the magnitude of the month-over-month growth was the same as what you saw in the September number, which was released last month, any uptick, like I said, is never good. And it also goes to show how difficult it is going to be for the Fed to bring inflation to its preferred 2% target. And more importantly, forget bringing to 2% target. It's almost nearly there, but to sustain it, but it's important to keep it there. That is the challenge. Now, again, more positives than negatives as far as I'm concerned. And it is the fact is that the more positives, if I were to take from this October PCE report, is that the PCE inflation data is still closer to 2% despite this marginal uptick. And this is what the US markets seem to have taken on board, as reflected by their overall weekly performances. And all three, as I said before, all three indices very much finished in the green, and that too very strongly finished in the green. Unless there is something dramatic that will happen with respect to inflation, I really think that markets have moved on. Okay, markets have they're going to take the inflation data on board going forward. Put simply, I just don't think inflation is going to be a major market driver anymore. I just simply don't think that. Unless, like I said, something dramatic happens. Now, here's where the unfortunate part comes in. Never be very careful what you wish for. You hope for, you hope that nothing happens, and then it's like you think you figured out life's answer. You figured out the answers to life. God changes the question paper, and exactly the unfortunate thing is exactly what happened last week. We did see some developments that actually could be a factor that causes the said dramatic impact on inflation. And that, ladies and gentlemen, is President elect Donald Trump's favorite buzzword: tariffs. 2 weeks back, when President elect Trump chose hedge fund manager Scott Bessent as the Treasury Secretary, markets simply cheered because they were of the opinion that a cooler head was going to lead one of the most important, if not the most important, departments in the United States government. More importantly, Besant is not someone who is gung ho on tariffs and sees them as something that will always be, he calls it the tariff gun. And he says the tariff gun will always be loaded and on the table, but it will rarely be discharged. He also is more disciplined and is someone markets consider to be a safe pair of hands for the job. And especially from a growth perspective, he was considered to be the safe bet compared to Howard Lutnick. Howard Lutnick did get the Commerce Secretary, but the Treasury Secretary is far more important. And so markets did rejoice when a more safer pair of hands got that job. That all went out of the window. That relief only lasted 72 hours when President elect Trump last week announced that he would slap tariffs of 25% on both Canada and Mexico on his first day in office and a further 10% on China until illegal immigrants and fentanyl, the dangerous drug fentanyl, stop entering the US. This announcement was not something that markets were anticipating, although with Mr. Trump, I always say expect the unexpected. Why are these tariffs a problem? Well, there's a case to be made that another tariff war would put significant pressure on inflation. In other words, that so-called dramatic event that I've been talking about in the start of this segment, which it could be because of tariffs. According to Deutsche Bank analysis, the proposed tariffs of 25% on Mexico and Canada, if implemented, would add 0.8% to a key inflation gauge next year if just half of the tariff costs are passed on to consumers. Just half. Okay, that's like the best case scenario. Worst case scenario, obviously, would be the full costs of the tariff impact being passed on to consumers, which clearly, I don't need to tell you twice, would have a significant negative impact on inflation. So clearly, the tariffs is something that investors have every right to worry about. Hey, even the Fed should be worried given the painstaking lengths it went through to tame inflation without causing massive unemployment, without causing a slowdown in growth, without causing a recession, and all of that. And now the Fed really has a headache in its hands. And despite this negative shock, the funny bit is both investors and the Fed have a lot to worry about when it comes to tariffs. But funny enough, despite this negative shock that was least expected, apart from a knee-jerk reaction to shares of automakers, markets largely took the tariff news in the stride, which says a lot about the bullishness and the positivity that surrounds market. I don't know whether it's because of Thanksgiving. I don't know whether it's because of the love for turkey. I don't know what it is, but they just took it in stride. The reason, so I dug a little bit deeper. I had a moment of reflection. Okay, what is going on? Is it too much of hyper positivity, too much of irrational exuberance? A phrase that I've used multiple times, time and time again, every time I've talked about the U.S. markets. So I did a little bit of digging, and I kind of did a bit of reflection as to why this could happen. And actually, you know what? Turns out the reason is very simple for why markets just took it in stride. Investors simply didn't fall for the tariff threat because they simply don't believe that President-elect Trump would act on the threat. And there is a case to be made on this as well. The president-elect, remember, loves to make deals. He calls himself the deals guy, loves to make deals. And he's had a history of making threats in order to bring the concerned parties to the table. He did that to Mexico, he did that to Canada, and he most definitely did that to China as well during the first term. So the latest tariff threats appear to be a negotiation ploy to bring two of US's biggest trading partners to the table so that they can renegotiate the USMCA deal. Now, the USMCA deal was formerly known as NAFTA, which Mr. Trump during his first term renegotiated, and now it's known as the USMCA deal. It's basically, not much different from NAFTA, but that's not how President-elect Trump sees it. So basically, he has had, Trump's had a history of making threats just to bring the parties to the table. So the markets have largely taken these threats in stride since they don't expect Mr. Trump to follow through with the threats. Let's say, even if he does follow through, markets are also of the opinion that now that the Fed is actually cutting rates and the US economy is on a very strong footing, Q3 GDP growth, we got it last week, was at 2.8%, stayed unrevised. And the latest data coming out also shows that Black Friday sales have been absolutely brilliant, with Americans spending nearly $11 billion just on e commerce, so just online, which should be phenomenal boost to retailers. I'm expected to see, the likes of Lululemon are reporting earnings in the coming week. So I'm very, very keen to hear from the retailers, management of the retailers, of these retail giants, as to how the Black Friday shopping spree has gone on. So largely, the US economy is on a strong footing. So the tariff threats, according to investors, even if President Trump were to follow through, are not likely to have the same negative impact they did back during the president-elect's first term, or back during Trump 1.0. Furthermore, they're also of the opinion that the Treasury Secretary elect Scott Bessent would make the president-elect's campaign promise of further tax cuts a reality, which should offset, according to investors, according to US markets, any negative impact from the tariffs. This is all well and good, okay? This is absolutely all well and good. And I do concur with the market's rationale. Okay, so I told you, I did a little bit of digging, I did a little bit of reflection, and I do agree. Okay, you know what? Makes sense. I do concur with the market's rationale. However, ladies and gentlemen, there's one small thing that the markets fail to factor in. And when I say small, I mean it in utmost sarcasm. There is one small thing markets are yet to factor in, and which I believe they should, is that when it comes to Donald J. Trump, when it comes to President-elect Trump, when it comes to Trump 2.0, you simply have to expect the unexpected. So we got to wait for the Fed to talk about. We gotta wait and see how this plays out. But you simply have to expect the unexpected. And just like that, because it was a holiday shortened trading week with little, with very little days of market action, this segment has also come to an end. So I'm going to go straight to the next segment now, which is the doctor goes home. So I'm going to take you from US to India now, and the news is not particularly great. As I take a sip of the water, I'm just telling you right now, news is not particularly great, so buckle up. Right, what do we have to talk in India? It's again some macro data. Okay, it's all about macro data from India as well this week. Last week, in the week gone by, unsurprisingly, we got the other leg of India's macro data coming in much worse than expected. If inflation went up, GDP data actually went down, according to the latest data. Now, you already know this. I don't need to tell you again and again and again. And you clearly are a lot more, you have a lot more common sense. What do we need? We actually need it to be the opposite way. Inflation needs to go down and GDP needs to go up. Well, clearly that's not played out. Inflation has gone up, GDP has come down. So not particularly great. Now, here's the catch. Economists expected to Q2 GDP, Q2 Indian economy GDP to go down. But I'm sure even the magnitude of the GDP slowdown might have taken even the most pessimistic economists by surprise. Let me give you some context. Both a survey by Economic Times as well as a poll conducted by Reuters saw economists' expectations of Q2 GDP for the Indian economy around 6.5%. Now, this is a significant slowdown from the Q2 of GDP of last year, when actually GDP growth smashed expectations and came in at 8.1%. So these were the expectations. The expectation was there will be a significant slowdown, but it would be to the tune of 6.5%. What was the reality? Much, much worse. Q2 GDP in reality actually came in at 5.4%, which actually marks a 7-quarter low and more than 1%, a full percentage point lower than what economists expected. To give you some further context, Q1 GDP this year was 6.7%. 6.7%, we've gone down to 5.4% in the second quarter. And the slowdown was primarily driven by manufacturing, which is again shocking, which grew 2.2%, with the mining and quarrying sector actually contracting by 0.1%. Yet another metric that is a core measure of economic activity, which is the real gross value added, GVA, grew by just 5.6%, a sharp slowdown from the 7.7% growth it registered during the same period last year. Bad news, bad news, bad news. And it also, the icing on the cake is it came in much worse than what economists were expecting. Now, this data, ladies and gentlemen, cannot be surprising if you are an investor and you have experienced firsthand the kind of corrections that the Indian markets have been undergoing in recent months. The factors that led FIIs, foreign institutional investors, to sell 94,000 crores in worth of equities in October and then a further 27,000 crores in November are the exact factors that have contributed to the sluggish growth of the Indian economy in the second quarter. You have inflation, which I explained last week, getting hotter thanks primarily to the retail food inflation, which has been registering a double-digit growth. Not a good sign at all. And it's been registering double-digit growth for a while now. In October, just to remind you, food inflation surged 10.9% and overall inflation breached the Reserve Bank of India's high end of the target band of 6%, coming in 6.21%. For more on inflation, check out episode 107, last week's episode. If you have an economy where inflation is red hot, surely that would erode consumer purchasing power, subsequently having a negative impact on GDP growth. So the first factor is red hot inflation clearly has caused a negative growth impact. Then you have the corporate earnings, which in Q2 were subdued and sluggish to say the least, and one of the main reasons behind the recent equity market sell-off that you've seen. Major firms reported their weakest quarterly performance in 4 years. So clearly, growth was never going to be good. On top of all of this, as if things didn't, as if things weren't bad already, you have the urban Indian consumer who has become very cautious when it comes to spending. Urban private consumption, according to the Economic Times data, accounts for 60% of GDP. So a sluggish consumer clearly did not help the Q2 GDP growth. Okay, look, when it comes to India, for the last few episodes, I've given you a lot of negatives. Okay, I've given you a lot of negatives. In fact, when I interviewed Charles Sunnox as well for episode 106, he was also saying valuation of Indian equities has been bad. So I know this show has been giving you a lot of negatives for the last couple of weeks regarding India. But if you really dig deep, and we really dig deep on the show, and if you keep your emotions at bay, another thing that we do here on the show, then you will see that there are actually positives to take, even from the recent subdued, sluggish, whatever negative term you want to call it, GDP data. The agricultural sector, for instance, bounced back really well during the quarter after a forgetful last 4 quarters, growing 3.5%, which, just to give you further context, was double the growth it registered during the same period last year. Trade, hotels, and transport segments also saw a very nice bounce, growing 6% compared to 4.5% during the same period last year. Construction maintained a very steady growth of 7.7%, and although this was a far cry from Q2 of last year when it grew at 13.6%, however, the fact that despite a slowdown in government spending during the quarter, it was still good to see the construction sector maintain a reasonably strong growth. Finally, private final consumption expenditure, PFCE, surged 6% in Q2 compared to 2.6% in Q2 of last year. The government final consumption expenditure, GFCE, also saw a recovery, growing 4.4% after several quarters of negative or minimal growth. Now, the obvious question, that comes to investors' minds is whether India is heading towards the dreaded phase of stagflation, where growth becomes stagnant, yet and the environment remains highly inflationary. The simple answer, ladies and gentlemen, is no. Okay, India is not moving. Indian economy is not moving to a stagflationary environment. The second half of FY25 is expected to pick up pace now that a lot of the uncertainties have gone away. The strong performance by the incumbent party in both Haryana, an agricultural powerhouse, and Maharashtra, a significant contributor of GDP, should ensure policy continuity, which should subsequently drive growth. The harvest season was very strong this year, which means that not only should the agricultural sector continue its momentum, but it should also bring some relief to food inflation, which subsequently brings down the overall inflation. And the festive season has been strong. How strong? We will get a very clear picture of that in the next couple of days when Indian automakers release their November sales data. The commentary from various auto executives has been bullish, which suggests that the growth might soon be coming back to this sector, that would further give evidence that the Indian consumer has resumed his or her spending. Regarding the auto sales data, that will be featured in the last episode of 2024 next week. Okay, so don't worry, I got you back. with when it comes to auto sales. And then you have the wedding season, which is expected to be amazing and massive this year. Average budgets for Indian weddings this year is expected to hit 36.5 lakhs and approximately 51 lakhs on average if it's a destination wedding, which translates to a year over year growth of 7%. Some of you might very well be doing this. According to the Confederation of All India Traders, CAIT, 48 lakh weddings are expected to occur between November and December alone, which is subsequently expected to generate 6 lakh crore rupees. Imagine how many zeros that is in this business. A fantastic boost to the hospitality sector for sure. So when you factor in all this, okay, all this positive, I told you I gave you a lot of negatives, but this week I did give you a lot of positives as well. When you factor in all these positives, you should not be surprised that the RBI has actually maintained its GDP growth projection for FY25 at 7.2%, despite the sluggish Q2 figure. And yes, this would be lower than 8.2% from last fiscal. But if you were to tell me that the Indian economy grew 7.2% while inflation continued to remain red hot, then I will take that any day as a long-term investor in the country. And speaking of inflation, I know I gave some pretty grim take when it came to rate cuts, but the truth is we are closer to the end game than before. We might not be where the US is. Indian economy might not be. The Central Bank of India, or Reserve Bank of India might not be where the Fed is. And a rate cut cycle might still be some time off, as I've mentioned to you countless times before, but we are not far off compared to same period last year. And a rate cut, ladies and gentlemen, can only mean one thing: catalyst for growth. As such, when one takes the long-term picture, the India's growth story remains firmly intact. Do not, and I repeat, do not let one sluggish quarter put you off. And with that, we move to the final segment, Dr. Dissects, where I will be discussing my favorite streaming platform, streaming company, streaming giant in this case, Netflix, ticker NFLX. Now, first some quarterly numbers. It had an outstanding quarter, in my opinion. Netflix beat on both the top and bottom line estimates once again, with Q3 revenues coming in at $9.82 billion, up 15% year over year, and beating analyst estimates by 57.6 million. Diluted EPS of $5.40 was up 45% year over year and comfortably beat analyst estimates by 27 cents. While global streaming paid memberships grew 14.4% year over year for the quarter, net subscriber additions saw a considerable fall, down 42% year over year. The third quarter of last year was when the company's password sharing crackdown took shape, which explains this year over year decline. However, the company's focus, ladies and gentlemen, on profitability is very clear, as operating margins came in at 29.6%, much stronger than the 22.4% figure it attained during the same period last year. Operating margins were also ahead of the company's own guidance of 28.1%. So this is some staggering numbers, by the way. Free cash flows also showed considerable growth, coming in at $2.2 billion, an impressive year-over-year growth of about 16%. Regarding guidance, once again, very strong, guys. Q4 revenues now projected to come in at $10.1 billion, which represents a year-over-year growth of 14.7%. Operating margins for Q4 are expected to come in at 21.6%, which would imply a significant jump from the 16.9% it generated in Q4 of last year. Diluted EPS is expected to come in at $4.23, which would translate to a massive year-over-year growth of 100.5%. The company also expects paid net additions to be higher in the fourth quarter on a sequential basis due to normal seasonality and a strong content slate. If these Q4 estimates come true, then it would imply that the FY24 revenues would grow 15% year over year, and the higher than expected revenues have led the management to project FY24 operating margins of 27%. Previously, it was 26%. They bumped it up by 1%. Finally, management expects FY25 revenues to come in between $43 and $44 billion, year-over-year growth of 11 to 13%, and FY25 operating margins would be at 28%. A lot of data, a lot of quarterly numbers. Let's head to the takeaways now. We know we don't just discuss numbers, we also dissect the quarter. It's called Dr. Dissects, yeah? So let's go to the takeaways now. First one, major highlight, by the way, of the company's third quarter was how the company's content has managed to not only drive subscriber growth, especially in the ads tier bracket, but also enable the company to deliver strong subscriber engagement. Third quarter subscriber engagement, a metric that Netflix uses to demonstrate customer retention, came in at about 2 hours per member per day on the back of strong content slate, which included the likes of Perfect Couple, Monsters, the Lyle and Eric Menendez story, and the latest seasons of Emily in Paris and Cobra Kai. It not only allowed the company to deliver strong revenue and margin growth, but also enabled it to build a strong membership base for its ads business, as evidenced by the 35% quarter over quarter jump in ads membership. The jump in ads membership has been so strong that it has exceeded the company's ability to monetize its ads inventory, which is not a bad problem to have if you're Netflix. Looking ahead in the fourth quarter, the company is set to launch one of the strongest content slates it has ever released in recent times, in my opinion. This includes the likes of Season 2 of Squid Games, Season 4 of Outer Banks, and Season 7 of Love is Blind. At the same time, the company is also set to launch two of its most ambitious shows from Latin America. In fact, it's already released the biopic on legendary F1 driver Ayrton Senna, and 100 Years of Solitude, a show based on the iconic novel of the same name by legendary author Gabriel Garcia Marquez. Then there is the much talked about Mike Tyson versus Jake Paul boxing match, which went phenomenally well despite the technical glitch. There was a technical glitch. There were a lot of user complaints on X, formerly known as Twitter. A lot of tweets were flying around saying, the stream's buffering. It's not buffering. We can't watch the game, can't watch the fight, all of that. And yet it had the most record we have ever seen for a boxing fight for the streaming platform. I think it came around 60 million or some. It was a staggering number that Netflix launched for the Mike Tyson versus Jake Paul fight. Now the fight didn't go. I don't think the fight was particularly great. Netflix doesn't care as long, and as a Netflix investor, you shouldn't care as long as it drives. It drives customer retention, and it drives customers onto the platform as well. Now, you also have two massive NFL games matches on Christmas Day. As I've talked last time, I talked about Netflix. The company is seriously ramping up its sports programming. And remember, just to put the icing on the cake is WWE Raw, along with several WWE paid live events, will be live streamed on Netflix from Jan 2025. I've subscribed to the WWE platform, just got an email from them today saying membership has been automatically canceled. From Jan 1st, 2025, you've got to switch to Netflix if you want to watch WWE. So I am a Netflix subscriber, so I have no problem. Don't need to spend another £10 per month on it. So on WWE, now I can watch it on Netflix, and I'm sure a lot of people are feeling the same thing. Now, 2025, in addition to the whole WWE switch, it will also see the return of Stranger Things, the final season, and Happy Gilmore, along with shows from Shonda Rhimes and Ryan Murphy. Oh my God, the amount of content that this company produces, this company releases. Like I said, this content slate in fourth quarter is one of the best I've seen in recent times. I'm so excited. I can't wait for 24 to be wrapped up. I can't wait. I'm so happy it's getting wrapped up with NFL games and on Christmas Day. And then when we move to 25, I get to see WWE on Netflix. And then not to mention, I'm eagerly waiting for the final season of Stranger Things as well. And, and the likes, and the likes, Stranger Things, the likes of Happy Gilmore, so on and so forth. So the content slate has been absolutely nothing short of phenomenal. In my opinion, Netflix has already won the streaming wars. Okay, it's been delivering consistent revenue and profitability growth. On top of that, been delivering smashing content. It's won the streaming wars. End of story. The company even overtook a legacy Hollywood studio in the US for the first time in Q3 with respect to demand for original programming. All of this can be attributed to its ability to consistently deliver high quality content, which keeps users engaged. Q3 was no different. For Q4, the company has already given some strong guidance, which once again can be attributed to its content. The strong content slate has even allowed the company to increase prices in multiple regions, with Italy and Spain being the latest countries to join the list. As Netflix is set to finish this year on a high, the latest quarter proved why no competitor can come remotely close to it. The next takeaway: when a company's management comes out and says it is unable to keep up with the demand, it's usually positive news. While the same can be said about Netflix's ads business, the uncertainty surrounding the ads business remains, which can leave investors a little uneasy, especially since I see its ads business as the next catalyst for growth. The positive takeaway, however, for the ads business during the third quarter was the tremendous progress made by the company in growing its ad tier membership. For the third quarter, as I mentioned earlier, membership for its ad tier grew 35% sequentially, building on the 34% sequential growth seen in Q2. The ads tier accounted for over 50% of new signups in countries where the company has introduced this plan. And in terms of engagement, the company found that members in the ads tier were engaging with similar content as the non ads plans members. Both sets also had similar views. All of these highlights are positive and banishes the question surrounding the cannibalization of the non ads plan and whether the ads plan would negatively impact margins and overall profitability and all of that. Listen, I'm not going to lie. There is still the question of the company's ability to monetize its growing ad inventory. For a while now, the management has mentioned this and that they're in the early stages of the ads business and that a lot of work needs to be done. Q3 was no different, as the management during the earnings call reiterated this message. The company remains on track to launch its own ad server in Canada in the fourth quarter before expanding it to the rest of the ads market in 2025. However, when it comes to contribution, management reiterated during the earnings call that the ads business will not be making any meaningful contributions to its top and bottom line in FY25. The last time I spoke about Netflix, I did mention that investors shouldn't judge its ads business harshly as it is making progress with each passing quarter. While I do maintain that stance even today, I would have still preferred to see some more commentary on the progress made in the space. Instead, the message was largely the same as Q2, and while there is no reason to panic given that the company's content slate is too strong and that it should help the company to grow even in FY25, this uncertainty surrounding monetization of the ads business is an area that I simply can't ignore. If the same message is maintained in the fourth quarter as well, then I would start worrying. Got my book out. It can only mean one thing: valuation, right? So let's jot down some numbers. Management expects FY25 revenues to come in between 43 and 44 billion. Given the company's FY25 content slate, which includes the likes of Squid Game Season 2, Stranger Things series finale, new season of Wednesday, new Knives Out film, as well as the arrival of WWE Raw and WWE PLEs, I expect the company to have a very strong year overall. FY24 revenues are set to match the company's high end of the guidance, which is also my estimate. And given that the content slate is even more attractive for FY25, in my opinion, I don't see any reason why the company can't repeat the feat again in FY25. As such, I have assumed FY25 revenues to come in at the high end of the guidance, which is 44 billion. So my estimate, FY25 revenues, 44 billion. Management now expects FY25 operating margins to come in at 28%, expanding by 100 bips from FY24. This is a reasonable estimate, in my opinion, given that the company has been managing its expenses in a disciplined manner, an argument I raised last time I spoke. Therefore, I've assumed FY25 operating margins of 28%, which translates to operating profits of 12.3 billion. So FY25 operating profits, my estimate, 12.32 bill. Okay, so the first one's revenue, second one's operating profit, 12.32 bill. I've assumed FY25 non-operating expenses to be 708 million. Okay, remember the mill and the bill, yeah? So 708 million, which would approximately be the average net non-operating expenses in the last 5 years. I've left my effective tax rate assumption to be the same as last time, which is 13.3%. So 13.3% is the effective tax rate. All right. Taken together, you get FY25 projected net income. Remember, these are projections, yeah? Projected net income would come in at 10.1 bill. Okay, projected net income for FY25, 10.1 billion. According to the company's latest income statement, which the weighted average shares of common stock used to calculate diluted EPS was 437.9 million. Okay, that's the weighted average of shares. Okay, and the lights are off. Really have to fix my office lights, by the way. All right, so weighted average of shares is 437 million. So that would be, if you do that, then FY25 diluted EPS projected would come in at 23.06. Okay, 23.06 is the FY25 diluted EPS, slightly lower than my previous estimate of 24.2. The company, according to LSEG data, currently trades at forward price to earnings of 30.9, 30.8, which is close to its historical 2-year forward PE multiple of 29.7. Given that the company is dominating the streaming landscape and given the structural tailwinds such as stronger content slate in FY25 and the untapped potential of its advertising business, I believe it needs to trade near its 5-year historical median of 33.9. So I have taken forward PE at 33.9. Okay, 33.9 is what I've taken. So I've taken forward PE multiple of 33.9. Right. A forward PE of 33.9. So let's do 33.9 multiplied by 23.06 will result in a price target of $782. Okay, $782, higher than my previous target of 734. Unfortunately, my ladies and gentlemen, the company's already smashed my price target. I still maintain my price target, still have to reevaluate the company in Q4, but it's already smashed. It's trading at 886 now, so it's more $100 more. Does that mean you sell? No. Does that mean new investors should buy? Also no. So in short, my rating on the company is hold. Last time the rating was a buy, rating downgrade. I am downgrading the rating to a hold, but that is purely on valuation, not on the long-term prospects. This is why I said do not short this company. New investors, it's just that I just feel like new investors might be better off waiting for a pullback before getting into this name. Bottom line, Netflix had yet another outstanding quarter, beating on top and bottom lines once again. Management also offered very strong guidance, both for the fourth quarter as well as for FY25. The latest quarter perfectly demonstrated the company's ability to keep churning out high quality content on a regular basis, with some of its strongest hits returning with new seasons in the fourth quarter as well as in FY25. And with the arrival of both NFL and WWE in its live programming category, Netflix has all but won the streaming wars, in my opinion. If there is an area of concern, and this is probably why new investors should probably hold off before getting into the name, it would be the uncertainty surrounding the company's ability to monetize its ads inventory. Despite seeing strong membership growth in its ads tier, the company during the latest quarter did not offer any new insights into its plans to monetize its ads business. Management merely stated that the business would take time to grow and it may have no meaningful impact on the company's revenues and profits in FY25. From a valuation perspective, there is still there is no upside. There is no upside from current levels. Oh, sorry, there's no upside, at least based on my valuation. All I'm saying is, with a strong grade of A minus on Seeking Alpha's momentum scale, I'm not surprised that the stock blew past my updated price target. This is Netflix's world, ladies and gentlemen. We are simply living in it. Q3 was a testament to this. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I will see you next week for one last time in 2024. So make sure you tune in next week as well. Until then, ladies and gentlemen, stay safe and make some money.